Welcome to the tutorial on financial accounting. Today the chapter is financial statement analysis. Every item of a financial statement has significance. That's why those items should be analyzed for decision making. And decision making depends on three characteristics. We can see liquidity, profitability and solvency. The short-term creditor take decision on the basis of liquidity of a company, and long-term creditor take decision on the basis of profitability and solvency, and stockholder take decision on the basis of profitability and solvency. Short-term creditor decide whether they should pay short-term loan, and long-term creditor decide whether they should provide long-term loan or debt, and stockholder decide whether they should invest for a share or a stock. Based on liquidity and profitability and solvency, the stakeholders take decision. Those characteristics can be found by analyzing the items of financial statement. Sometimes we need to do comparative analysis because comparison between the items of financial statement is helpful to know the characteristics, and this comparison can be done based on three different ways. The first one is intra-company basis. That means you can compare considering the intra-company basis. In that case, you will compare the item of financial statement, or you will find out the relationship of the financial statement within a company. That means the item within a company in the current year with the same item or relationship in one or more prior years to know significant trends. Trends means increase or decrease of that item. So intra-company comparison is done for the item within a company. The second basis of comparison is industry average. Means you can compare the item, or you can find out the financial relationship of the item of financial statement of a company with the industry average or norms or standards published by any financial rating service to know performance within the industry. Comparison with industry average will provide the idea about the performance within the industry. And the last one is intercompany basis of comparison. Intercompany basis compares an item or financial relationship of one company with the same item or relationship of other companies. Here other companies mean one or more competing companies to get insight into a company's competitive position. So intercompany means one company with another company. If we compare the items, then we can get idea about the competitive position of that company. What are the tools of analyzing financial statement data? We can see there are three tools to analyze the financial statement data. The first one is horizontal analysis, the second one is vertical analysis, and the third one is ratio analysis. By applying these three tools, we can analyze the items of financial statement. Let's see the details of these tools. The first tool is horizontal analysis. It is also known as trend analysis. Horizontal analysis is a technique by which we evaluate a series of financial statement data over a period of time. Here we can see example net sales of 2011, 2012 and 2013. So that is a series of financial statement data on net sales. In horizontal analysis, we analyze the data over a period of time. From this example, we can see the net sales of 2011, 2012 and 2013. For the purpose of horizontal analysis, we have to consider 1 year as a base year. Suppose the 2011 is the base year. Here the base year amount is 26,405. From this base year amount, we will calculate what is the increase in 2012. So here we can see the amount is 27,686. To get the increase of that amount, we need to consider this amount as a base year. So what is the formula to find out the increase or decrease or trend? We can see change since base period. The formula is we need to deduct the base year amount from the current year. Suppose this is the current year. From this current year we will deduct the base year amount, then we will divide by the base year amount to find out this percentage. Here we can see 104.9%. Since this is the base year, so this is 100%. From this base year in 2012 there is an increase. Again, by applying same formula, this is the base year, and if you consider this is the current year, we will get the increase of that percent. In horizontal analysis, we calculate the trend analysis. That means to know whether there is an increase or decrease in any item. For the purpose of example, we have shown the net sales of 3 years. We can apply same formula for every item. Here is one item, net sales. You can apply this formula for every item of financial statement. The second tool of analysis is vertical analysis. Vertical analysis is also known as common size analysis. And in vertical analysis, we show the item as a percentage of a base item. That means, suppose here we can see the total assets. This is the base amount. Comparing this base amount, what are the percentage of current asset, plant asset and intangible asset? If we consider the total asset as a base amount, so the current asset percentage is 55.6%, and comparing to base amount, I mean the total assets, the plant asset percentage is 43.6% and the intangible asset percentage is 0.8%. So this is the base amount. Comparing this base amount, what are the percentage of other item vertically? On the other hand, this is the amount of total liabilities and equity. If we consider the base amount, what are the percentage of other item? Considering this amount as a base item, the percentage of current liabilities is 18.8%, and comparing this base amount, the percentage of long-term liabilities is 26.5%. Comparing this amount, the percentage of total liabilities is 45.3%. So vertically, we are comparing the items with the base amount. This is the vertical analysis. Vertically, we are comparing the amounts with the base amount. Here the base amount is total liabilities or equity, and here the base amount is total asset. In this way, we can find out the percentage of other item comparing to a base item or base amount. The third tool of analysis is ratio analysis. This is very important analysis for analyzing the financial statement data. Ratio analysis expresses the mathematical relationship between one item and another item, or one quantity or amount with another quantity or amount. The relationship of ratio analysis can be expressed as a percentage or a rate or times or as a simple proportion. As per example, we can see if we show the relationship between the current assets and current liability, here the amount of current asset is 13,626 and the current liabilities is 3,926. If we compare this two amount, or if we calculate the relationship between these two amount, we can express the relationship as a percentage. The current assets are 347% of current liabilities, or if we express the relationship as a rate or times, we can see current assets are 3.47 times higher comparing to the current liabilities. If we express the relationship as a proportion, then we can say the proportion between current assets and current liabilities is 3.47:1. Now we can see the types of ratios. Broadly, there are three types of ratios: liquidity ratios, profitability ratios, and solvency ratios. In liquidity ratios, we can measure the short-term ability of a company to pay its maturing obligations and to meet unexpected needs for cash. Generally, the bankers and the suppliers are concerned about these liquidity ratios. On the other hand, by profitability ratios, we measure the income or operating success of a company for a particular period of time, and by the solvency ratios, we measure the ability of a company to survive over a long period of time. The short-term creditors are concerned about liquidity ratios, and the long-term creditor and the stockholders are concerned about profitability and solvency ratios. Let's see the details ratios under these three ratios. So under the liquidity ratios, the first ratio is current ratio. Current ratio can be calculated by dividing the current assets by current liabilities. So this is the formula of current ratio, current assets divided by current liabilities. By this current ratio, we can measure the short-term debt paying ability of a company. Current ratio is also known as working capital ratio, and we can get the working capital by deducting the current liabilities from the current asset. However, the formula of current ratio is current asset divided by current liabilities. Let's see a practical calculation from a practical problem. We can see in this problem there is a income statement and there is a balance sheets, and there are some additional information and some instructions. From the instruction we can see we need to calculate the ratios, and this is the income statement. We can see the net sales and the expenses and net income. This is the net income of 2 year. And in the balance sheet we can see the assets. There are two types of asset, current asset and long-term asset. And in the liabilities and stockholders equity, these are the liabilities, current liabilities and long-term liabilities, and these are the stockholders equity items, and this is the total liabilities and equities. From this information or from the items of this problem, we will calculate the current ratio. Let's see the formula again. The formula of current ratio is current assets divided by current liabilities. From the question we can see the amount of current assets is 2,15,000. So we will calculate the ratios for the year 2020. Here the current assets is 2,15,000. On the other hand, the amount of current liabilities is 1,45,000. Let's see the calculation. So here is the calculation. The amount of current asset is 2,15,000 and the amount of current liability is 1,45,000. So if we divide this, the ratio is 1.5:1. That means the current assets is 1.5 times considering the current liability as 1. So this is the current ratio. The next ratio under the liquidity ratios is acid test ratio. It is also known as quick ratio, and by this acid test ratio we calculate the immediate short-term liquidity. I mean whether the company is able to provide quick response to the short-term payment of loan. The formula of acid test ratio or quick ratio is cash plus short-term investment plus accounts receivable net amount divided by current liabilities. The basic difference between the acid test ratio and current ratio is that these are also the current asset, but in this current asset we should not include the inventory and prepaid expense, and all other current assets should be shown to calculate the acid test ratio. Let's see the practical calculation. From the question we can see the amount of cash is 21,000 and short-term investment 18,000 and account receivable net amount is 86,000 and the amount of current liabilities is 1,45,000. Let's see the calculation. This is the calculation acid test ratio. We added the 21,000 cash, 18,000 short-term investment and 86,000 net receivables, and we have divided it by the current liabilities 1,45,000. The answer is 0.86:1. That means quick asset is 0.86 against the current liability of 1. The next ratio under the liquidity ratios is accounts receivable turnover, and by this ratio we calculate or we assess the liquidity of the receivables, and the result is shown as a times. By this ratio we can find out the times of collecting receivables during the period. The formula is we should divide the net credit sales by the average net accounts receivable, and to get the net credit sales we should deduct the cash sales minus net sales. To get the average net account receivable we should add opening receivables and closing receivables, then divide by 2. So let's see the practical calculation from the math. From the problem we can see net sales, that means all are credit sales, so we don't need to deduct the cash sales. The amount of net sales is 6 lakh, and on the other hand receivables are 86,000, 74,000. We will use these two amount because we need to calculate the average net receivable. So for the purpose of calculating average net receivable, we need to divide these two amount by 2. After adding these two amount, we will divide by 2 to get the account receivable. So what is the calculation? Here we can see the calculation. Account receivable turnover ratio. This is the net sales 6 lakh and this is the average receivables. We got this average receivables by adding the opening balance of receivables 86,000 and the closing balance of receivables 74,000 by dividing 2. So this is the 80,000 average receivables. By using this average receivables, we get the receivable turnover ratio is 7.5 times. That means we collect the receivables 7.5 times per year. Now we can see we can convert this account receivable turnover as another ratio that is called average collection period. And for that calculation, we need to divide the account receivable turnover by 365 days to get the average collection period. Account receivable turnover is converted into average collection period by dividing 365 days. By this calculation, we can get idea after how many days we can collect our account receivable. The next ratio under the liquidity ratios is inventory turnover, and by this ratio we measure the number of times on average the inventory is sold during the period. By this inventory turnover, we measure the liquidity of the inventory. The formula is we need to divide the cost of goods sold by average inventory. Average inventory can be found by adding beginning plus closing inventory and divide by 2. To get the average inventory, we should apply this formula. And to get the inventory turnover, the formula is cost of goods sold divided by average inventory. Let's see the problem and solution. From the question, we can see the amount of cost of goods sold is 4,15,000 and the amount of inventory is 90,000 and 70,000. We will take this two amount because we need to calculate the average inventory. So what is the calculation? Let's see. So this is the calculation. Here the inventory turnover ratio 4,15,000. This is the amount of cost of goods sold, and the 80,000. This is the average inventory. To get this average inventory, we have added the opening 90,000 and the closing 70,000 inventory. I divide by 2. So the amount is the average inventory is 80,000. So by applying this average inventory, we get the inventory turnover ratio is 5.2 times. So what does that mean? That means we can sold our inventory 5.2 times per year. Now we can see we can convert the inventory turnover as a days in inventory. What does that mean? That means after how many days we can sold our inventory. The formula is we will divide the inventory turnover by 365 days. Now we can see the profitability ratios. The first ratio on the profitability ratio is profit margin. The formula of profit margin is net income divided by net sales. We get the percentage of profitability by this profit margin. Let's see the practical problem and solution. So to calculate the profit margin, we need the net sales and net income. Here the net sales is 6 lakh and the net income is 38,400. So this is the calculation of profit margin ratio. We need to divide the net income 38,400 by the net sales 6 lakh. The amount is 6.4%. That means comparing the sales, our profit margin ratio is 6.4%. The next ratio under the profitability ratio is asset turnover ratio, and by this asset turnover ratio we measure the efficiency of a company in using its asset to generate sales. What is the formula? We can see the asset turnover formula is net sales divided by average total assets, and to get the average total asset we need to add the opening and closing balance of total asset divided by 2 to get the average total assets. Let's see the problem and solution. So to calculate the asset turnover, we need the net sales and the average assets. Here we can see to calculate the average asset, we need to take the opening balance of asset and closing balance of asset. This is the opening balance and this is the closing balance. By using this opening and closing balance of total asset, we will get the average total asset. Let's see the calculation. This is the calculation. asset turnover ratio. Here the 6 lakh is the net sales and 5,99,000, this is the average total asset. To calculate this average total asset, we have shown that average assets equal to 6,38,000, this is the closing balance of total asset, and 5,60,000, this is the opening balance of total asset. By dividing 2, we get the 5,99,000, this is the average assets. By applying this average asset, the asset turnover ratio is 1.0 times. The next ratio under the profitability ratio is return on asset. Here net income will represent the return. To calculate the return on asset, we will divide the net income by average total assets, and we already know that average total asset means beginning plus closing balance of total asset divided by 2. So let's see the practical problem and solution. So from the problem we can see the amount of net income is 38,400 and the total asset is 5,60,000 and 6,38,000. We need to get the average amount of total asset. Let's see the solution. Here you can see the calculation return on asset ratio. This is the 38,400 net income and 5,99,000. This is the average asset. We already know that we have calculated this average asset by applying this formula, opening and closing divided by 2. The return on asset ratio is 6.4%. The next ratio under the profitability ratio is return on common stockholders equity. By this ratio, we get the idea about how many income is earned against the investment by the stock owners. So what is the formula of calculating return on common stockholders equity? We can see net income divided by average common stockholders equity. There will be little change in this formula if the company has a preferred stock beside the common stock. In that case, the formula is net income minus preferred dividends divided by average common stockholders equity. Let's see the problem and solution. So from the problem we can see the amount of net income is 38,400 and the equity amount is 3,73,000. There is only common stock, there is no preferred stock. So this is the solution of calculating return on common stockholders equity ratio. Here the 38,400 is the net income and the 3,61,500, this is the average equity. To calculate this average equity, this is the 3,73,000, this is the closing equity, and 3,50,000, this is the opening equity. By dividing 2, we will get the average equity. Here we don't need to deduct the preferred stock because there is no preferred stock, only the common stock. By dividing the 38,400 net income by 3,61,500, this is the average equity. The return on equity is 10.6%. The next ratio under the profitability ratio is earning per share. By this ratio, we can measure the net income earned on each share of common stock. So what is the formula? We can say earning per share, net income minus preferred dividends divided by weighted average common share outstanding. We need to get the number of shares, common shares, then we will divide the net income minus preferred dividends. But in our math, there is no preferred dividends because there is no preferred stock. However, let's see the problem and solution. Here the amount of net income is 38,400 and there is no dividend expense, preferred dividend, and here we can see we need to calculate the number of shares by dividing this 1,50,000 by the par value or face value of each stock. Let's see the solution. Here we can see the solution is earning per share ratio. Here we can see 38,400, this is the net income, and 30,000, these are the number of shares. How have we calculated it? We divided the total value of common stock by the value per share. You can see our value of total stock is 1,50,000, value per share is 5. By dividing this amount, we get the number of share 30,000. Dividing the net income by the number of shares, the earning per share is 1.28. Here we don't need to calculate the weighted average number of common share because we calculate weighted number of share when there is a issue of additional share in the middle of year. But in this math, there is no additional issue of share in this company. The next ratio under the profitability ratio is price earning ratio. It is also known as PE ratio, and by this PE ratio we assess the company's future earnings. And the formula of price earning ratio is market price per share divided by earning per share. So from the problem we can see the additional information. The market price per share is 19.5. In the solution we can see the price earning ratio is 19.5. This is the market price per share, and 1.28. This is the earning per share. That is, this is the earning per share 1.28. Dividing the market price per share by earning per share, we will get the price earning ratio, which is 15.2 times. The next ratio under the profitability ratio is payout ratio. That means the dividend payout ratio. By the dividend payout ratio, we measure the percentage of earnings distributed in the form of cash dividends. And if the company is in high growth rates, then the payout ratio will be low because the company reinvests their income. However, the formula of payout ratio, the formula of dividend payout ratio is cash dividend declared on common stock divided by net income. So this is the problem, but in the problem we don't find the amount of cash dividend paid, but we can calculate it by adjusting the retained earnings. Let's see the solution. We can see the dividend payout ratio 15,400. This 15,400 is the cash dividend paid. How have we calculated it? We can see we need to add the net income with the opening retained earnings, then we will deduct the closing retained earnings. The opening retained earnings is 2 lakh and the net income is 38,400. By deducting the closing retained earnings 2,22,000, we will get the cash dividend paid. 15,400, this is the cash dividend paid, and 38,400, this is the net income. What is the ratio? 40.1%. This is the dividend payout ratio. Now we can see the solvency ratios, and the ratio under the solvency ratio is debt to asset ratio. Here debt means debenture or liabilities. By this debt to asset ratio, we measure the percentage of total asset that is provided by the creditors or the liabilities. And the formula is debt to asset ratio, total liabilities divided by total assets. We take both the current liabilities and the long-term liabilities. This debt to asset ratio is also known as degree of leverage. Higher the amount of total liabilities, there is a higher risk. But if a company has a stable earning, they can increase the degree of leverage or they can increase the debt. But from the creditor's point of view, a low ratio of debt to asset is usually desirable. The formula is debt to asset ratio equal to total liabilities divided by total assets. From the problem we can see the total liabilities is 2,65,000 and the total asset is 6,38,000. What is the solution? We can see debt to total asset ratio 2,65,000. This is the total liabilities, both current liabilities and long-term liabilities, and 6,38,000. This is the total assets. Debt to total asset ratio 41.5%. That means from the asset 41.5% is provided by the creditors or liabilities. The next ratio under the solvency ratio is times interest earned. By this times interest earned, we get idea about the ability to meet the interest payment as they come due. And times interest earned uses net income before income tax and interest expense. This is also known as earning before interest and tax. However, we can see the formula is times interest earned equal to net income plus interest expense plus income tax expense. These three items can also be considered in together as a earning before interest and tax and divided by the interest expense. From the problem we can see net income 38,400 and interest expense 7,800 and income tax expense 18,000. These three amount will be shown in the upper level and will be divided by the interest expense, that is 7,800. So let's see the solution. Here 64,200 is the summation of three items, that is net income plus interest expense plus income tax expense. 38,400, 7,800, 18,000. We can also take the another amount that is called earning before interest and tax. However, we can sum up these three amount. By summing up, we can see this 64,200. This is the net income, interest, income tax expense, or this is the earning before interest and tax, and divide by the interest expense 7,800. That means answer is 8.2 times. Times interest earned ratio is 2 times. These are the ratios, but ratios are not limited to these ratios. There are other ratios. You can apply those ratios as needed. Thank you.